Hello, guys. I hope your day is going well so far. My name is Joseph AGK and I want to keep you company today as before. Now, our topic of discussion today will be an introduction to financial statement. We're not going to do any calculations today, uh, but today we're going to cover the various sections of the financial statement of a company. Now, um, as you know, financial statement tell us the vital signs of a company, whether the company is making profit or not, whether also whether the company is a good investment. We use them to make decision to buy the stock of the company or not to buy the stock. So, so in our subsequent lectures after this, then we'll start doing analysis of financial statement step by step, so that you'll see that it is not really difficult to figure out whether a company is a good investment or not. So I'm going to show you in the coming weeks. But today, our topic will be to introduce you to the concept of financial statement. Like I said, I'm very sure that you're going to have fun in this lecture because it will really expose you to what is going on in the financial, in the stock market or in any company's life. Let me put it that way. Now, let me start by sharing my screen and then we can go from there. Okay. So again, my name is Joseph AGKOG. I forgot to add my name here. This. Now, let us begin. Let me make sure you're seeing this. I'm sure you're seeing it. Okay, good. Now, the financial statement. What is financial statement anyway? Like I've explained before, a financial statement report what happened to a company's assets, earnings. When I say earnings, I mean profits, dividends. Dividends mean what if you invest in a company, how much to be paying you every quarter as part of the profit. So it's a share of the profits that shareholders receive every quarter or every year, depending on if the company pays dividends. Some company doesn't pay dividend at all, but shareholders may not worry about that if the company's stock price is going up. So that is if there's a capital gain. Anyway, financial statements report what happened to that company's assets, earnings, dividends, and cash flow during the given time period. In some countries, it's annually. They report the annual financial statement. In America, you put this every quarter. This quarterly financial statement. So look at a few things that we need to know about the financial statement of a company now, or any company at all. First thing we want to know is this: that the stream of cash that or cash flow that the company generates, usually through sales, that's what determines the fundamental value, or what they call the intrinsic value of the company. And this is basically what we are trying to using financial statements to figure out what is the intrinsic value of that company. That is the value that is hidden. Let me make it more simple by using an example. Suppose our interests. I'm going to use a company like let me use Ford. I'm going to go to Yahoo Finance, finance.yahoo, and pull the financial statement. The price of that company. I can even use Macy's, any company at all. Let me use Ford. Ford, the trading symbol is F. That should bring up the Ford Motor Company. Yeah. Now, the current share price for Ford Motors Ford Motor Company is $12.23 per share. Now, the intrinsic value of this share means that if it is worth more than this amount, which is $12.23 per share, that is the intrinsic value we're talking about. It is worth more than this, but we don't know what it is. So this share might be worth $13 per share, but for some reason, investors have not recognized it. So that amount that is its worth that we don't know is the intrinsic value. So if you use your financial statement to analyze, if you analyze the financial statement of Ford Motor and see that this share is worth more than this, that means it's going to go up to maybe $40 per share in the next 2 years. You can buy it and hold. And you can get that information from the financial statement of the company. Now, if it is worth less than that, then of course you won't buy it. So anyway, so the main work of the CEO of any company is to increase this intrinsic value. That's what investors put him or her there to do for them. So long as the CEO keep making the intrinsic value going up and the stock price keep going up, the investor shareholders are happy. Whether the company pays dividend or not, they don't care because there's a capital gain that is consistent. The value of the stock is going up. Now, I think you get the point. Let us go back to our lecture PowerPoint. So now, the estimate of the future cash flows or what action that are most likely to increase that cash flow, to estimate it, or to estimate the cash flow or even the intrinsic value, investors analyze financial statements of the company. Now, I've already explained what the intrinsic value is. Now, let us move on to the next step, which is the 4 basic financial statements the company have. There are 4 types. I will have the balance sheet, the income statement, the statement of cash flow, and the statement of stockholders' equity. Now, this part, statement of stockholders' equity and balance sheet are usually together. So that's why we sometimes, when we're talking about the financial statement of a company, we use balance sheet, income statement, and statement of cash flow, because the other part, the fourth one, which is the statement of stockholders' equity, is always together with the balance sheet of the company. So I want you to understand that point. Okay. So let us explain what each of these mean. Okay. We go back to the balance sheet. Let us begin with the balance sheet. I just want to make sure that everybody's seeing this. Okay. Now, the balance sheet. What does the balance sheet tell us about the company? Well, basically, it is a snapshot of what the company owns, what they own, and what they owe. How much is what they own, and how much they owe to their suppliers or lenders. That's what the balance sheet tells us. Not only that, it also tells us the amount invested by the shareholders of the company. So this is this balance sheet. It tells us what the company owns, their assets, what the company owes to suppliers or to lenders. Also, the amount invested by the shareholders, the one we call stockholders' equity. See, now the income statement reports the revenue that the company generated. Now, usually the company generates revenue from sales, and also the expenses the company incurred during an accounting period, usually for a year or a quarter. So the revenues that company gets during an accounting period, the expenses they incurred, you see that in the income statement. Now, the statement of cash flow provide a summary of cash flow from that coming to the company and goes out. How much cash is coming in, how much has come in, how much went out. So basically, a simple way of explaining this is that it shows or provide summary of cash inflows and cash outflows during an accounting period. So in other words, the statement of cash flow basically summarizes a company's resulting balance in its operating, investing, and financing activities. Now, we're going to go into details about this financial statement. I'm going to describe the different sections. Then from next week, we'll start doing the analysis. The third one is there, like I said, the fourth one, which is also merged with the balance sheet, is the statement of stockholders' equity. The statement of stockholders' equity. So this financial statement, basically, when it says stockholder equity, we're talking about the ownership, those that bought the stock of the company. So, so the statement of stockholders' equity simply, tell us changes in ownership of the company, changes in stockholders equity or ownership interest in the company from the beginning of a given accounting period to the end of the next accounting period. So usually it contains things like the preferred stock, common stock. Preferred stock, these are types of ownership. Preferred stock are those ones they receive dividends before the common stockholders receive. They have more privileges. But then, to compensate the common stockholders for lacking those privileges, they have voting rights. Preferred stock doesn't have voting rights. Now, sometimes a company can buy back their stock. Buying back their stock from investors. Usually, that kind of stock that they buy from investors, we call it the treasury stock. So I'm sure that you must have heard of what they call stock repurchases by a company or stock buyback, when companies buying back their stock from the paying off the investors. So a company might repurchase its own stock in an attempt to avoid things like a hostile takeover or to boost the stock price. It's a kind of the investors see stock buyback as that's a signal that the company is doing well. Otherwise, why would somebody want to buy back their own stock? Usually, the managers or CEOs of companies and the board of directors, CFOs, they have some inside information about the company that shareholders may not know about or the market doesn't know. So when they start buying back their stock, the market sees it as a positive signal. Oh, these people have something that we don't know about this company. They know something good we don't know about this company. So it creates a good signal for the market to start rushing for their stock. And the end result is that the stock price now goes up. Not that they might not even have any information about the company, any negative information, any positive information about the company. But for some reason, stock buyback usually sends positive signal to the market. So me, I don't trust stock buyback like that because I see it as a type of financial engineering, just to massage your stock, make it look good to the market. Anyway, we're going to do an example on that and see why it leads to stock price going up, mathematically, eventually. So anyway, the type of stock that the company repurchases, we call them the treasury stock. Then also this statement of stockholders' equity also contains things like additional paid up capital, retained earnings, and unrealized gains or losses. Okay. Now let us look at the components of this statement of financial statement one by one. Let's start with the balance sheet. The balance sheet has three main components: the assets, liabilities, and net worth or equity. Remember, I told you that this statement of stockholders' equity is presented together with the balance sheet. So that's why sometimes when we say financial statement, we're talking about three things: balance sheet, income statement, and cash flow statement. Anyway, assets simply means what the company owns, and we, in the balance sheet, we tend to list them in the order of I would say in the order of liquidity. Now, before we proceed, I want to show you some balance sheets, some financial statement of companies. Now, they are required by the SEC, the Security and Exchange Commission, to file their reports, including their financial statement every year to the public, because they are publicly owned company. They are public. Anybody can buy stock on there, so that there's gonna be some kind of transparency. So now you can have access to any company at all, so long as it is publicly traded. You can have access to their financial statement by simply going to either you go to Yahoo Finance or you go to what they call the SEC, which is Securities and Exchange Commission website. Now, for this lecture, the financial statement we'll be using is done for Walmart, and I'm going to show you how you can access it. Remember, I mentioned the three main financial statement and the balance sheet, income statement, and cash flow statement. So let us take a quick look at the balance sheet, income statement, and cash flow statement for Walmart Incorporated. So let's go to the SEC website so you can see it. Now I have sec.gov. So that brings it up. Now let's see, you can see what we call company filings. Okay. Now I'm going to put the trading symbol for Walmart, which is WMT. So you can see that it brings up a drop-down menu where you can see Walmart Incorporated right here. Let me just make sure you guys are seeing this. Yep, I think you guys are seeing it. You can see Walmart Incorporated right here. Oh. Okay, see. So I'm going to click on it. And then it will bring up the financial statement. So usually 10K statements, see annual reports. You click on that. See, March 2021. So you can see the annual reports filings for Walmart. You click on it, it will load it. So you will see the this is you have the financial statement should be here. Okay, right here you can see right here financial statements. You click on it, and then you can see the all the financial statements should be here. 1 minute, I'm putting them up. Okay. Just 1 minute, I'm gonna put it back so you can see it. Okay, see the first one, you can see the consolidated Walmart Incorporated. This is the consolidated income statement for Walmart. See, statement of income. Now, this is the consolidated Walmart comprehensive. Okay, this one is the same thing, but this one is a consolidated statement of comprehensive income. Now we have the balance sheet for Walmart. You can see right here, consolidated balance sheet for Walmart, and on. This is for the statement of equity. This is for cash flow statements. You can see everything inside. So if you look at the Walmart, the balance sheet, which is where we are starting, you can see that it comes with assets first, then liabilities. Then you can see the equity side of it right here. So so I think you get the point now. And then okay, let's go back to our work. Now so the asset is what the company owns. Okay. Now, the asset part of is then the liability is what the company owe, the debts that they owe, or the obligations that arise during the course of their business operation. So, from assets will in balance sheet, we record them according to their liquidity, how fast they can be converted to cash. So, you start with cash, short-term investment, account receivable, plant and equipment, and inventories. These are the major things. Then they might add other things there that will show you, these components. Now I'm going to show you. I was able to put the Walmart balance sheet into Excel, so I'm going to show you all these parts that I just mentioned. You look at the Walmart balance sheet that I have here. Okay, this is the income statement. So this is the balance sheet right here. So you can see it right here. You can see the assets, liabilities, and equity. See? So you have cash and cash equivalents, receivables, inventories, and so on and so forth. Now, then net worth, or what the company, the ownership, represent the ownership of the company, who own the companies, the amount of share they have in the company. That is the net worth or owner's equity that we see in the balance sheet. Now, let's see the balances. We have an assets section of the balance sheet. Under the assets section, we have what we call the current assets. Current assets represent those assets that can be easily converted into cash. They can easily convert it into cash within 1 year. So things like cash and cash equivalents. Cash is already cash anyway. Now, cash equivalents are things like marketable securities, such as certificate of deposits, treasury bills, treasury notes, money market fund. These are the things that you can sell within 1 year. As a matter of fact, many banks that issue CDs, that is the certificate of deposit. When you buy it, they are lending money to the bank, and they usually mature in 30 days or in 3 months or 6 months or 1 year. So the same thing with treasury bills. So these are not cash; they are cash equivalent, but you can sell them within 1 year. We call them they come under current assets. Now, account receivable. Now, these are the payments that your customers owe to you. For example, suppose you have a Walmart sell large quantity of materials to a business. Let's say $5,000 worth of let's say household items to a business, maybe a hotel, and the hotel have not paid yet. So that amount that they owe Walmart becomes accounts receivable for Walmart. Usually they give you 1 month or less to pay up your account if you are a business customer. I'm talking about business to business now. So that amount is called the account receivable because you can get it within less than 1 year. Okay, it's an asset. Then inventories simply means goods that the company is selling, what they are selling. So for example, a company like Toyota, with the company, their inventory is not all the cars they made for the year that they want to sell for that year. A company like Home Depot that sell building materials, all those things that they are selling are the inventories. So this is a very important asset, because if the inventory is moving up, selling off the shelf very fast, that means the company is making money. But even if the company is not selling and restocking frequently, that means something that for some reason they're not making money. Okay. Next is the non-current assets, which represents those assets that cannot be turned into cash within 1 year. So you have things like real estate. You may or you may not sell it within 1 year. Plant and equipment, patents, physical items, goodwill, that cannot be converted into cash within 1 year. So you call it non-fixed, I mean, most fixed assets are like that, you know. So now next is the liability section of the balance sheet. Remember, liability represent what the company owes. That means the debts, their debts or obligations that they have for their lenders. We have the current liabilities, which means those liabilities that are due within 1 year or less. So we call them current liabilities, and we arrange them in order of how fast they are due. Yeah, those that are due earlier, we put them first in the balance sheet, followed by the rest of them. So now we have accounts. First one is accounts payable. If a company like JCPenney bought inventories on credit from their suppliers in Asia, that became accounts payable. That supplier might say, okay, pay us in 1 month. So, but because it's amount they owe, we call it account payable. Unlike account receivable, whereby let's say that JCPenney supplies some large quantity of clothes to a hotel, and then say, okay, and that become account receivable to JCPenney. But if they buy supplies like clothes and shoes from a company in Asia or any other company, even in America here, so long as they bought it on credit, it becomes accounts payable to JCPenney. So they have to pay their bill. Then we have notes payable. This one is just like a credit card for the company. How much? This one, in form of a loan from bank that the company paid interests every month. So it's different from accounts payable. They're totally different things. And then we have accrued expenses. This one is one that is regular. Periodic expenses like wages to employees, interest on things like notes, and also taxes that they pay for accrued expenses. I'm sure you're having fun so far. So you can say, I want to break these balance sheet components so you can see what they are. So that by next week, you can now start, when I start using them to analyze a company, you will not get to be lost. Now, next thing in line is our, next in line will be non-current liabilities. These ones are not due within a year. So they're not likely to be settled within one financial year. Things like debentures, long-term loans, like bonds payable. Like a company use bond to borrow from the public. So they sell the bond to you. When you buy the bond, you are lending money to the company. Now, if the company, usually they pay you what they call coupon payment every 6 months for holding that money, for allowing them to hold that money and use it to do their projects. Let's say that it's a 5-year bond. Every 6 months, they pay you the coupon payment. Every 6 months. Then when it's 5 years, they give you back your money plus another for the interest. So it's a good investment, but it's a long term. So they're not, we call them non-current liabilities or long-term debts. Long-term lease obligations and pension benefit obligations, things like that. Okay. So the net worth or owner's equity section of the balance sheet. This refers to the proportion of the total value of a company's assets that can be claimed by the owners. So we normally calculate them by doing the assets minus liabilities. Now the next thing that we have is the retained earning. We call them retained earning because that's what they are. They represent the accumulated portion of a business profit that are not paid to as dividend to shareholders. So instead of paying back the dividend, the company decided to put it back to expand their operations. So we call them retained earnings, just retained profits. And for them. Now, another thing you see in that section is the common stock. A common stock simply represents a partial ownership of the company. So it has voting rights as a way of compensating them, because this one, preferred stock, have more privileges than common stock. For example, they receive regular dividends. Yeah. And if the company is going out of business, they get their money back first before the common stock. If they get their money back and there's nothing left, that means the common stockholder will get nothing. Now, to compensate the common stockholders for all these things that privileges that they don't have the reporting right. They can vote, to elect board of directors, who then hire, the CEO. They can vote on many decisions that the company make, which preferred stockholders cannot do. Now, so let's become the treasury stock. I've already explained it. When a company buy back their own shares, we call that type of share the treasury stock. So additional paid-in capital is any payment received from investors for stock that exceeds the par value of the stock. Now, we have finished with the major component of the balance sheet. These are the major ones that you see in every balance sheet. Any other thing added to it is just a minor adjustment by different companies. Yeah. But you must see this component that I've already mentioned. Now let us turn our attention to the components of the income statement. Now, first thing you see is net sales, or what they call sales revenue. Yeah. Some company write as sales, then some company please as revenue. So, but before that, let me show you an income statement, how it looks like. I put the income statement of Walmart. So as you see right here, it starts with net sales, or what you call it, sales, because revenue comes from sales. Then another thing that you have there, just a minor adjustment, cost of sales, that is cost of revenue. See, because revenue have costs, you have to have things like advertising expenses and so on and so forth. And then you can see the other things that you have, the operating income, and so on and so forth. Now you see the net income, which is the profit, and so on and so forth. Now let me take you back to our work. So for the income statement, you have net sales, which are revenue that the company generates minus the discount or return. Now we have things like depreciation. If a company have assets like a building, equipment, they depreciate, they lose value over the years. And that is what we call depreciation and amortization. When it is a physical asset like land, plant, and equipment, we use the term depreciation. But when it becomes things that are intangible, like patents, copyrights, trademark, and so on, we use amortization. So next thing you see net income in the income statement, which represents the company's total earnings or profit. When I say, each time I say earnings, I mean profit. So usually we calculate it by taking revenue and adjusting for the cost of doing business, depreciation, taxes, and so on and so forth. Now, get this, we also call net income the bottom line because it is listed at the bottom of the income statement, which I can show you here. The income statement for Walmart. So when you say bottom line, that means the profit. See, that's the last thing that we have here. It is here, and you can also see the next one. You will see the net income from common share, but it is the last thing here. Any other thing after that is the mere minor adjustment. Next one is net income attributable to non-controlling interest, net income attributable to Walmart, then net all kind. It is at the bottom of the income statement. That's why we call it the bottom line or the profit. Okay. Now let us go back to our PowerPoint. Then we have the cost of goods sold, or what we call the cost of revenue, which is also in the income statement. So this includes cost of wages, labor, raw materials, and other expenses that the company incurred during that accounting period for producing goods and services. Next thing we have there, from this we can from the other components we can use to calculate earning before interest and taxes. Sometimes it is called operating earnings, or some people call it operating profits. But know that it is earning before interest and taxes, which means that it basically indicates how profitable a company is. So we calculate it by saying because the acronym, the abbreviation is EBIT, revenue minus cost of goods sold minus depreciation minus operating expenses. Okay. There's another type. This one you won't see it, but we use it, the things in the income statement, to calculate the EBITDA, which is another name for another way of gauging the profitability of the company. So EBITDA simply means earning before interest, taxes, depreciation, and amortization. So we use sales minus cost of goods sold, excluding depreciation, then other expenses. I don't worry, when we start calculating this, you see that they are actually easy. They are really fun, actually fun, because especially if you are investing based on these computations, you will see that you can put the money and leave it for 1 year, 2 years, and it will grow if you did your homework very well. Now, sometimes there are things that can mess up your, calculations. Those things, we call them the acts of nature. I'll give you an example. Last year, 2020, nobody knew that COVID-19 would strike the world. So all the estimates people did about some companies, especially a company like the airline industry and the restaurant industry, the hospital, let me put the hospitality industry. So prior to the COVID-19, they are all making money. Then the COVID-19 struck, and then the money just disappeared. Now they're coming back now. There was a time I posted on Facebook that you buy stock when there's blood in the street, even if it's your own blood. I was telling them last year about it, that the airline is down now, but it's gonna go up. This is the right time to jump in. Some people listened to me and bought airline stock, and they are having fun now because the airline is coming back. Many people are doubting it. Anyway, I leave I leave them to make the judgment. Okay. Anyway, back to our work. We have let's look at the components of the stockholders' equity. I've already explained it when I was describing the balance sheet. We have the preferred stock, common stock, retained earnings, and so on and so forth. Now, let us look at the cash flow statement. Now, which is the third financial statement. So we have it. This is divided into this component is divided into three: cash flow from investing activities, cash flow from cash flow from operating activities, cash flow from investing activities, and then cash flow from financing activities. So we are going to look at these cash flows one by one. So when we speak of cash flow from our operating activities, we mean money coming in and money going out from day-to-day operation of the company. So it means that cash flow from operating activities represent the ongoing regular business activity, the money that the company brings in, or the one that goes out from ongoing, regular business activities, like things like manufacturing or selling goods or providing a service. Money coming in from there, or even paying export expenses. Like when they buy supplies, they pay for the expenses, and then money from working capital. So all this money that come in from day-to-day trading operation, the company, is what we call cash flow from operations. Now, Usually, this is if you're analyzing a company, if you're in a hurry, and you don't have the time to do all this big analysis. This is where you put your attention. Cash flow from operation. If it starts to deteriorate, it always signals a problem that the company has a problem. When it is negative, starting to get negative, something is wrong. Usually lead to a problem. That's why this is the reason why you see a company that will declare profit, very nice profit. Then within 3 months or 5 months, it is bankrupt. Why? Because the cash flow from operation have gone bad for a while. People don't know. People were not paying attention to that. They are looking at stock price and the stock price and the profitability. But this company is actually having a big problem, but you don't know. So it always usually show at cash flow from operation, because it means that the company cannot pay their suppliers. You might have difficulty even paying salaries, but nobody knows about it. It's internal problem. But the market is still, because maybe from the last quarter profit was good, and they are just grinding, figuring out a way to get by, gradually, but really struggling. So when it gets bad, if you're not in a hurry, just go to look at the cash flow from operation. If it's negative, that will tell you that you have to look more and see what is wrong with the company. So we usually calculate it by using a net income plus non-cash item. I'm going to show you how it goes in a few minutes. Let me show you for Walmart. You can see from here that we have the cash flow statement. You see cash flow from operating activities. Let me make it a little bit bigger. So, okay, so you can see it's right here. Cash flow from operating. So for the year 2020, 2021, 2020, and 19, let's see what Walmart cash flow. You see net cash provided by operating activities. So how do you get it? I'm going to show you right now. You just here equals, you add net income here plus, I would have said sum, but we see we have gaps here. So let me just do one by one. Plus this, plus that, plus they say all these things are the adjustment, depreciation, and amortization. Then losses on disposal of business operation. Those that are losses, they use negative. Those are the income cash coming in, they use positive. Okay. Plus ASDA pension contribution. Okay. Plus this. Okay. Plus. Hold on, let me see what is going on here. It's not registering it, but I'm gonna fix it now. Don't worry. Okay. Now let's do it again. So see net cash flow luckily for Walmart has positive cash flow for operation. So let's start from here. This plus just 1 minute. Something is wrong with the. Let me see what has gone wrong on this. Okay, make sure I'm sharing it properly. Okay, we are ready. Net cash flow from operations. So let me do it on this side again. Equals when it goes. Okay, plus 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 okay plus receivable net, inventories. Just these are just adjustments. Okay. Plus the last one. It is okay. Then enter key. See the same thing I have here, and then you can copy the results to here and to do the same calculation. You can see that we have the same thing that I got here. See, so it's positive for this, and then And then we can and just delete it. So that's how so you add all the cash flows, those coming on and those going out for that come under cash flow from operating activities. When you add them, and if it's negative, that's usually signal a problem. So I'm gonna clean it up here. So that's how I'm trying to show you how to get these numbers here. I'm gonna make it no, okay, no fear. Okay, good. Now let's look at cash flow from investing activities. In this case, we have working capital. Okay, let me give an example of because I mentioned things. I said, how do you calculate this cash flow from operating activities? I mentioned that it is get by net income plus non-cash item plus changes in working capital. So what are not non-cash items and working capital? Non-cash items, like I said, are things like depreciation when you buy an asset. You know, some expenses that they're not really physical cash, but you make adjustment for them. Yeah, you claim their value, make an adjustment that you attach the value to them. Things like depreciation, amortization, depletion, stock-based compensation, more things like that. They're not physical cash, but they represent cash. For example, if you buy an asset, let's say that asset is worth 20,000 that you use for the business, IRS might allow you to depreciate the value over the years, maybe about 4 years. So you can depreciate 5,000 every year. So it doesn't mean that money come into your the 5,000 came into your position. No, it's just a kind of adjustment that give you $5,000 credit every year for the 4 years of life of the depreciable value of that asset. So that's why we call them non-cash items. Now, but the working capital is the capital you use for the day-to-day trading operation. And we usually calculate it by using current asset minus current liabilities. Let me give you an example of this. See here that imagine a company A that has this company has the following information: that the net income is 1.5 million, and the working capital is 900,000, and that the company's combined amortization, depreciation, and so on is 400,000. So let us use this to calculate the company's cash flow from operating activities. I show this in this slide here. Net income is 1.5 million, and the rest of them. A non-cash item 400,000. Changes in capital, working capital. So basically, what you do is to add them, and then you get this. So I'm going to show you how it is obtained. So I'm gonna so I put them here already. So you can see the net income is this, non-cash item is that, so that the cash flow from operation is just to add. So if this, let's say that net income is negative, it will mess up the whole thing. That shows you that there's a problem. This plus okay, this plus that will give you the amount which you can change to dollar if you want. See, okay, make it so you can see it. Next in line will be the cash flow from investing activity. This presents the aggregate change in a company's cash position. That's because of the gains or losses they gain from their they make from the investment activities. Investment usually in financial markets or in their subsidiaries, or any money that comes in from an amount they spent investing in things like plant and equipment and so on and so forth. So we usually calculate them by, again, adding the purchase or sale of long-term assets, like a capital expenditure, or purchase and sale of other businesses, things like merger and acquisition, or the purchase and sale of marketable securities like certificate of deposits, the That's what we call it. Any bond can be bond, you know, and so on and so forth. So we call them any money that coming from that investment activities, cash flow from investment activities. So then we have things like investment activities can be outflows, like money going out, like the company buy plant and equipment, things like software or or maybe a building. They bought a building on land. That means money goes out. Or they purchase marketable securities, then bonds, treasury bills, money market securities, and so on and so forth. Or they bought another company. That can also mean cash going out. Now, inflows, things like they sell a property. Maybe they have a business or a branch that is not making money for years. They say, okay, this branch is toxic. Let us offload it and then get the money because it ties down a lot of cash, and yet it's not making money. They can just sell it, and then that means positive cash flow. Then also they suppose that they bought some bonds or commercial papers they bought, which they can now sell when they mature and make money. That money comes in. Or that if they bought an equipment that is bringing in a revenue, cash revenue, Now that one is the third one is the cash flow from financing activities. This one has to do with them cash coming in and cash leaving the company resulting from debt issuance. Sometimes a company might want to buy another company. Let's say that the time that Facebook bought Instagram, or the time that Facebook bought WhatsApp, they have to raise the money. They might sell bond to raise large amount of money and to buy it. So that is financing. Cash flow that come from financing activities. Or they might even issue a new stock that will invite the public to buy the stock. That will be money coming in. Okay? Or they can even repurchase stock. So at the end of the day, the cash flow from those activities represent cash flow from financing activities. For example, look at this company. It says, suppose that a fictitious company, CCF Corporation, has the following. You know what? Let me just use Walmart. Walmart should be better for me to illustrate this cash flows from investing activities. Sorry, from financing activities. Now, let's look at the cash flow statement. We have it from financing. See, because net change from short-term borrowing, see, negative. All these are in millions, which is 324 million. It is negative because it represents money going out. Proceed from issuance of long-term debt. For this year, to 2021 is zero. For 2022 is 5 point something billion, and the one is 15 point something 872 billion. The repayment of debt, long-term debt, okay, amount they borrowed, see, is negative because it's represent money going out. Now, the payment of dividend that they paid is 6.116 billion, and so on and so forth. Purchase of a company stock, repurchase. See, they all represent negatives. Then other financing activities. So when you add all this, let's say you add it here, okay? So you can put equals, because they are together, I'm going to use sum. Sum, okay? I'm going to add this here, close it. See, I got the same thing here. So now I can now copy it to the other years. You can see that I have the same thing I have here. Let me highlight this one so you can see what I'm saying. So I have the same thing here. So let me convert all this to money because all these things are money. So I'm going to make it a dollar symbol. You can see that this is negative. Now, if a company, when the cash flow from financing activities is negative, or especially cash flow from investing activities, especially because it's negative, it doesn't always mean that the company is bad. It is different from cash flow from operations. Operation is different. That one is mean day-to-day operation. If they have a negative cash flow for that one, and they can't even pay for their immediate need. It's just like saying that somebody cannot pay for the basic food they can eat to survive. So that one is different. If it's for investing and financing, if it is negative, if the company is actually expanding, doing large projects that will generate revenue in the future. If they have a negative cash flow from investing and cash flow from financing, it won't be that bad. I'll give you an example. In the early 2000s, Amazon, we all know about Amazon, was expanding so fast, it had negative cash flow for years, but they are expanding. So all those red lines have turned to black because now Amazon have positive cash flow because they have done so much investment and they are so big now that they have so rich too. So I'm sure you got the point. Let's see. Let's go back to where we are. So next will be the key points here. So I wrote here that the increase in current assets and other cash, such as inventories and account receivable, all those increase in those items because they involve payment. So they decrease cash. But when you decrease those things, like if you decrease your inventory, that means you sell off some inventories, cash will go up. So usually, if you remember, they do it all the time. Companies like especially grocery stores or store like Walmart. Sometimes when they have an inventory that have been a long time, that is tying down some cash, they want to release those cash so that they can use it to do more investment. What they do, if it's not selling off so fast, they can say, okay, let us do Thanksgiving sale, or let us do Christmas sale, or President Day sale, where they cut the price by 50, 30%, 40%. That will bring in customers who will buy those, snatch up those inventories, and release the cash to Walmart. With that cash, they can use it to buy, restock new inventory. Otherwise, if they cannot do that, if there's a new thing, something that is new that came out, if they cannot have money to restock, their competitors might do that and then take the market from there. So that's why they have to say, okay, take this, move out this inventories, release the cash so that you can use the cash for more projects that will bring more revenue. Purchase of assets is a negative cash flow because you pay for the assets. That means money living out. Then when you buy you sell a new asset, it means positive cash flow. That means money, coming in. So this is why we use statement of cash flow to answer these few questions, especially these ones. Is the firm or is the company actually, generating enough cash to purchase additional assets required for growth? Or is the firm really generating enough cash to use to repay their debt or to invest in new products? So investors look at in financial statements, ask this kind of questions, because it helps them to know the company better. Now, in our subsequent lectures starting from next week, I'm going to show you how to use this financial statement to analyze the company performance, to check the vital sign of the company, to see if the company is doing well or not. This is what analysts do every day in the Wall Street. They analyze different companies. See, if this one is show them any potential, they buy it and hold it for a year or 2 years. See what happens. If it rises, then they sell it and make money. Now, if you do this analysis always for a company and before you buy, you see that most of the time, at least 70% of the time, their returns will be positive. I mean, of course, there's going to be companies that will just go out of lose money, but you have more winners, more winning stock than more losing stock. As a goal of every stock investor, your goal, you already know that you cannot win, or your stock cannot be winning, but the goal is to have majority winning. That's how you make it. Then those that are losing might eventually start winning again. So anyway, I know I use this lecture to describe to you what the financial statements are, the various components of the financial statement, the income statement, balance sheet, cash flow statement, the various section of them. And then next lecture, we start using them to analyze the company. I'm sure you enjoyed the lecture so far. And thank you for listening. And you have a blessed day. Once again, my name is Joseph Ejike Oji. I hope you will to see you in my subsequent lectures. Have a good day. Bye bye.